BND and individual treasuries can both provide high-quality fixed income exposure, but they solve different problems. BND is a continuously managed portfolio containing thousands of investment-grade bonds. It provides diversification, monthly distributions, and the simple way to own a broad section of the U.S. bond market through one ETF. An individual treasury is one specific obligation issued by the U.S. government. It has a defined maturity date and a known payment schedule. If you hold it until maturity, you receive its face value, assuming the government meets its obligations. So the difference can be summarized in one sentence. BND is a diversified portfolio tool. An individual treasury is a precise cash flow tool. BND is usually easier to manage because the fund automatically replaces securities as they mature and maintains its target exposure. Treasuries require more decisions, but they allow investors to choose exactly when principal should become available. Neither option is automatically better because the correct choice depends on the job assigned to the money. Are you trying to diversify a long-term portfolio, or do you need a known amount of principal on a specific future date? To answer that properly, we first need to look inside BND and see what the fund actually owns. BND stands for Vanguard Total Bond Market ETF, but the phrase total bond market can create the wrong impression. The fund does not own every type of bond. BND targets the broad, taxable investment-grade U.S. dollar-denominated bond market. It generally excludes tax-exempt municipal bonds, inflation-protected Treasury securities, and below investment-grade high-yield bonds. As of May 31, 2026, BND held 11,455 bonds. Approximately 69% of the portfolio was classified in the U.S. government category. That category included treasuries, agency securities, and government-backed mortgage securities. The remaining portion primarily included investment-grade corporate and other non-government bonds. This means BND is not simply a basket of treasury notes. Its return can also be affected by corporate credit spreads, mortgage prepayments, changes in housing-related securities, and demand for government-related debt. The fund's average effective maturity was approximately 8.1 years, while its average duration was 5.8 years. Its portfolio yield to maturity was approximately 4.7%. Those characteristics make BND a broad intermediate-term bond allocation, rather than a short-term cash substitute. That diversification is one of the fund's greatest strengths, but it also creates risks that do not exist when an investor buys one treasury and holds it directly. So let's examine exactly what the treasury investor receives. When you buy an individual treasury security, you choose a specific maturity and payment structure. Treasury bills are short-term securities that mature in 1 year or less. They are generally purchased at a discount and pay their face value at maturity. Treasury notes commonly mature in 2, 3, 5, 7, or 10 years. Treasury bonds have longer maturities, including 20 and 30 years. Notes and bonds pay a fixed rate of interest every 6 months until maturity. At maturity, the final interest payment is made, and the face value of the security is returned. That maturity date is the central advantage. Suppose a retiree knows that $20,000 will be needed 5 years from now. A treasury maturing near that date can be purchased specifically for that future expense. The market price may move before maturity, but those price changes become less relevant if the investor does not need to sell early. However, the amount returned at maturity is the treasury's face value, not necessarily the exact amount originally paid. An investor who buys in the secondary market may pay a premium or discount, and if the treasury is sold before maturity, its market value can be higher or lower than the purchase price. Now that the structures are clear, the obvious question is income. Which one was paying more in 2026, BND or individual treasuries? To create a fair snapshot, we can compare BND and Treasury rates using data from the same period. On July 7, 2026, BND's 30-day SEC yield was 4.54%. On that same date, the 1-year Treasury par yield was 4.06%. The 2-year yield was 4.19%. The 5-year yield was 4.27%, and the 10-year Treasury yield was 4.55%. At first glance, BND appeared to provide nearly the same income as a 10-year Treasury and slightly more than shorter maturities. But this is not a perfect apples-to-apples comparison. BND's SEC yield is a standardized estimate of the fund's recent income after expenses. Treasury par yields are market rates derived from the Treasury yield curve for specific maturities. BND also holds corporate and mortgage-related securities that may offer additional yield as compensation for risks not present in a pure Treasury. The fund's income will evolve as old bonds leave the portfolio and new bonds are purchased. A Treasury's yield is connected to one security and one maturity date. Therefore, a slightly higher displayed yield does not automatically make BND better. The investor is accepting a different combination of duration, credit exposure, reinvestment, and cash flow uncertainty. And the biggest structural difference appears when we ask a simple question: when do you get your principal back? An individual Treasury has a defined ending point. If you buy a 5-year Treasury and hold it until maturity, the security pays interest according to its schedule and returns its face value at the end of 5 years. This creates a known principal payment date that can be matched to retirement spending, college expenses, a home purchase, or another future obligation. BND works differently. The bonds inside BND mature, but the fund itself does not. When securities mature or leave the fund's underlying index, the portfolio reinvests the proceeds into other bonds. This allows BND to maintain broad and relatively consistent bond market exposure. But this also means shareholders do not reach one date when the fund returns a predetermined face value. To access principal, a BND investor must sell shares at the market price available at that time. The price may be higher or lower than the original purchase price. This does not mean BND is defective. It means BND is designed to remain invested, while an individual Treasury is designed to complete its contractual life. A Treasury also has market price risk if sold early, but holding it to maturity provides a clearer path toward a defined nominal value. So principal certainty favors individual Treasuries for known future expenses. However, the amount of price volatility experienced before that date depends heavily on duration, and this is where BND's preset portfolio profile must be compared with building your own Treasury exposure. Bond prices generally move in the opposite direction of market interest rates. When new bonds begin offering higher yields, older, lower-yielding bonds become less attractive, so their market prices usually fall. Duration estimates how sensitive a bond or bond fund may be to those changes. As of May 31, 2026, BND had an average duration of approximately 5.8 years. Using the standard duration approximation, a 1 percentage point increase in comparable interest rates could produce a price decline of roughly 5.8%. A 1-point decrease could produce a gain of approximately the same magnitude. But this is only an estimate. Actual results depend on which parts of the yield curve move, changes in credit spreads, mortgage prepayment behavior, fund cash flows, and portfolio adjustments. With BND, the investor accepts the fund's broad intermediate-term duration profile. With individual Treasuries, the investor chooses the maturity. A 3-month Treasury bill has far less rate sensitivity than a 30-year Treasury bond. This flexibility allows investors to match duration more precisely to their spending timeline, but choosing short maturities creates more frequent reinvestment decisions. Choosing long maturities locks in income for longer, but creates greater price volatility. BND simplifies the decision by providing one diversified duration profile. Treasuries provide more control, and duration is not the only difference in how investors experience their income. The payment schedules are also very different. BND generally follows a monthly distribution schedule. That feature can be attractive to retirees who prefer income arriving regularly throughout the year. However, the payment amount can change. The distribution depends on the income produced by the securities in the portfolio, fund expenses, portfolio turnover, and other accounting factors. A monthly schedule does not mean a fixed monthly payment. Individual Treasury notes and bonds generally pay interest every 6 months. At maturity, the investor receives the face value in addition to the final scheduled interest payment. This schedule is less convenient for someone trying to pay monthly household expenses directly from each security. But the problem is easy to manage. Treasury interest and maturing principal can be collected in a cash reserve. The retiree can then transfer a consistent amount from that reserve into the spending account each month. This separates the timing of investment payments from the timing of household bills. BND offers smoother operational convenience. Treasuries offer more precise security-level cash flow planning. The investor should therefore ask whether the priority is receiving frequent distributions or knowing exactly when a specific bond will return principal. There's also another major difference. BND spreads money across thousands of securities and several bond sectors. An individual treasury concentrates the credit exposure in one issuer, but that issuer is the U.S. federal government. BND's broad diversification is difficult to reproduce manually. With one ETF purchase, the investor receives exposure to more than 11,000 bonds. That reduces the effect of a default or downgrade involving one corporate issuer. The portfolio also spreads exposure across treasuries, agencies, government-backed mortgage securities, and investment-grade corporate bonds. But diversification across security types introduces several forms of risk. Corporate bonds can lose value when investors become concerned about company finances. Mortgage-backed securities can behave differently when homeowners refinance faster or slower than expected. Credit spreads can widen during recessions, creating losses even when treasury yields are stable. Individual treasuries remove most of that complexity. The investor receives exposure to obligations of the U.S. federal government without corporate credit risk or mortgage prepayment risk. Traditional default risk is generally considered minimal, but the portfolio is concentrated in one government issuer, and the securities still face interest rate and inflation risk. So BND is more diversified by issuer and security type. Individual treasuries provide pure government credit exposure. More diversification does not automatically mean less risk of every kind. It means risks are distributed differently. The correct choice depends on whether the investor wants a broad bond market allocation or a security designed for a specific future payment. Before comparing reinvestment, taxes, and costs, this is the right point to support the channel's no-hype approach. If you prefer fixed income analysis without guaranteed income claims or dramatic predictions about the next Federal Reserve meeting, subscribe to Boring Money Wins. The goal of this channel is to explain what each investment actually does inside a real portfolio. For bonds, that means looking beyond the yield displayed on the screen. We examine duration, maturity, credit quality, taxes, reinvestment risk, liquidity, and the timing of future spending. If this comparison is helping you understand the difference between owning a bond portfolio and owning a specific bond, click the like button. That helps YouTube recommend the video to investors who may currently believe that every bond investment works the same way. BND and Treasuries are both useful tools. The mistake is expecting one tool to perform every fixed income job. A diversified fund may be ideal for long-term portfolio exposure. A treasury maturing on a known date may be far better for a liability that cannot be postponed. Now, let's return to one of the most overlooked differences. When a bond matures, someone must decide what happens next. BND makes most of that decision automatically. An individual treasury leaves the decision directly with the investor. That creates a trade-off between convenience and control, known as reinvestment risk. Reinvestment risk is the possibility that future cash flows will have to be invested at lower yields. Inside BND, reinvestment occurs continuously. Bonds pay interest, mature, are called, or leave the underlying index. The fund then purchases other securities that fit its strategy. This automation is convenient because the shareholder does not need to manage every maturity, but the investor has little control over the yield available when each security is replaced. If rates fall, the portfolio gradually reinvests at lower yields and future distributions may decline. With individual treasuries, the investor controls the decision. When one treasury matures, the principal can be spent, held in cash, or reinvested into a new security. A treasury ladder spreads those maturity decisions across multiple dates. If rates rise, maturing principal can be reinvested at higher yields. If rates fall, the longer rungs continue earning rates that were locked in earlier. The ladder reduces the risk of reinvesting the entire portfolio on one unfavorable date. However, it requires ongoing management and does not eliminate reinvestment risk. It organizes the risk. BND automates the process. Treasuries make the process visible and controllable. For investors who value simplicity, BND may be preferable. For retirees matching maturities with spending, direct control may be more valuable. And in a taxable account, another factor can influence that decision: state and local income taxes. Interest from U.S. Treasury marketable securities is subject to federal income tax. However, that interest is exempt from state and local income taxes. For investors living in states with relatively high income tax rates, this exemption can make an individual treasury more attractive on an after-tax basis. BND holds a mixed portfolio. Part of its income comes from qualifying U.S. government obligations, while another part comes from corporate, mortgage-related, and other securities. Therefore, investors should not assume that every dollar distributed by BND is exempt from state income tax. Each year, the fund provider generally reports the percentage of income attributable to qualifying U.S. government obligations. The usable exemption can depend on the investor's state, the fund's annual composition, and local tax rules. Inside an IRA or another tax-advantaged retirement account, the immediate state tax difference may be less relevant because investment income is not normally taxed each year in the same way as a taxable brokerage account. This means account location matters. An individual treasury may have a meaningful tax advantage in a taxable account. Inside a retirement account, investment structure, maturity control, and portfolio role may matter more. Taxes should never be analyzed using the headline yield alone. The correct comparison is after-tax income after expenses and trading costs. And that brings us to the practical ownership question. Which option is cheaper, more liquid, and easier to manage? BND charged an annual expense ratio of 0.03% in 2026. That means approximately $3 per year for every $10,000 invested, before considering normal trading costs. In exchange, the investor receives broad diversification, automatic portfolio maintenance, monthly distributions, and the ability to trade one highly liquid ETF. BND shares can generally be bought or sold throughout the trading day. The market price may trade slightly above or below the fund's net asset value, and the investor also faces the bid-ask spread. Individual treasuries do not charge a fund expense ratio. At auction, investors may be able to purchase newly issued securities through Treasury Direct or participating financial institutions. Treasuries can also be traded through brokerage accounts in the secondary market. But no fund expense ratio does not always mean zero cost. Secondary market purchases may include bid-ask spreads, brokerage pricing differences, or dealer markups. Treasuries also require the investor to choose maturities and manage reinvestment. BND minimizes operational work. Individual treasuries maximize customization. For an investor making small recurring purchases, BND may be simpler. For someone constructing a large liability matching ladder, the additional treasury management may be worthwhile. The correct decision becomes clear when we separate investors into three groups: long-term accumulators, retirees with known expenses, and investors who need both diversification and precise cash flow. A long-term accumulator may prefer BND. The investor can add one diversified bond fund to a stock portfolio, reinvest monthly distributions, and maintain broad fixed income exposure without selecting individual securities. The fund can serve as a simple portfolio stabilizer and may be easier to rebalance alongside stock ETFs. A retiree with known future expenses may prefer individual treasuries. If money will be needed in 1, 2, 3, or 5 years, securities can be selected to mature near those dates. This reduces dependence on selling a bond fund at an unpredictable market price when cash is required. A third investor may benefit from combining both approaches. Individual treasuries can fund near-term spending and known liabilities. BND can provide broader intermediate-term exposure for money that does not require a specific maturity date. This hybrid approach gives each asset a separate job. The Treasury ladder provides control and scheduled principal. BND provides diversification, automatic reinvestment, corporate and mortgage exposure, and operational simplicity. The most useful question is therefore not which one will outperform next year. That requires predicting interest rates, credit spreads, and market behavior. The better question is, do I need a diversified portfolio or do I need a payment on a specific date? Once that question is answered, the final verdict becomes much more practical and much less dependent on forecasts.
BND is usually the better portfolio tool. It offers broad diversification, a low expense ratio, monthly distributions, automatic reinvestment, and simple trading through one ETF. It can work well as a long-term core bond allocation for investors who accept a continuously changing market value and do not require the fund to mature on a specific date. Individual treasuries are usually the better cash flow tool. They allow investors to choose exact maturities, match principal payments with future expenses, maintain pure U.S. government credit exposure, and potentially receive valuable state and local income tax exemptions. But direct treasuries require more management. The investor must choose maturities, evaluate purchase prices, handle reinvestment, and build diversification across time. A hybrid strategy may provide the strongest overall structure. Treasuries can cover near-term spending and known liabilities. BND can provide broader fixed income exposure for the longer-term portfolio. The final decision should be based on three variables. Yield tells you what income is currently available. Duration tells you how sensitive the investment may be to interest rate changes. Maturity tells you when principal becomes contractually due. BND provides a diversified bond portfolio. Treasuries provide defined payments. Neither is universally superior because they are not designed to do exactly the same job. Use BND when you need a portfolio. Use treasuries when you need a date. Use both when your financial plan requires both functions. That is not exciting, but that is how boring money wins.